Hello from the children of planet Earth.
What's up, everybody? Good morning. All right, quick analysis of the day. We're walking into a pretty steady open. Nothing crazy happened overnight. Market's rational across the board. Inside DD bands. VIX is still looking a little elevated. We're gonna see if we get that volatility crunch today. If not, we're gonna probably have that event that we've had last week, the credit rating downgrade, continue into the end of the month. Usually see those volatility spikes will be kind of short-lived. The thing is a non-event or a black swan. The volatility sustained. VIX futures been trading up above 17 for the past 4 sessions. So we'll see if that's just a pause in the uptrend, or if this is actually the catalyst that's going to start a downward month. Look at this, opening inside D band, rational, good. VIX above triple B, overshooting pivot still, and still at elevated 17. I want to see the VIX start trading lower if this is going to continue to move higher. Like I said, analyze the monthly maps to see how this works and how the positional data is shifting over the next month. There has been some changes, some significant changes in it. We'll talk about that in a little bit. It's not as strong as it was. So this is something to take note of. This could be a reversal. Could be. Not saying that it is, but it could be.
Hello from the children of planet Earth.
Getting everything ready to get our trading day started here. Liquidity map spike, QQQ ready to go. Get the last couple of details left in futures, and hopefully I'm trying to get that push live tonight. I've been testing it for a week. Everything's looking good, and I'm loving it. Morning, guys. What's up, Luigi? Michael Etai. Violent. First day as a funded trader. Nice job. Really well done. I'm excited for you. All right. Don't get excited and burn out on your first day. Remember, gotta keep it like it didn't even happen. It's a new day. It's another day. Right? Every day is a trading day. And you're ready to go. You killed it. I'm excited for you. Did you do Violent? Did you do a static type drawdown or a trailing type drawdown account? Which one did you use? Which company? I'm loving. Okay, market's looking really great at the open. I'm liking what I see. Opening outside redistribution zone on the box. Resilience is looking pretty hot today. Positive 90, positive 90 is an update right out the door. I do like what I see, so let's wait till we get the liquidity maps come through. I can't complain here. We're trading MES, micros, mean reversion short. Let's see if we get it here. Okay, so we are illiquidity pocket mean reversion now. So this was a illiquidity pocket inside of here. Meh. Okay, this is not the best. Not the best, at least below hedge pressure as well. This is gonna be really hard for me to want to take a decent trade off of today. Dang, I was excited. I was excited with the strong resilience. Okay, so let's talk about what we're gonna get right out the door. So it's not an update today. It's gonna have to work its way up if it goes higher. Not the best sign. So what we're seeing here today. Okay, y'all want me to analyze this? You're right out the door. This bumps in the next resistance. That's an illiquidity pocket because resilience is greater than 0. Illiquidity pockets love to play through here. Liquidity pockets love to play through there. Okay. DD is likely going to be bullish, which means bull zone is support. So this is likely to support. And of course you have hedge pressure as resistance. So opening, this is opening in an illiquidity pocket. So there's no closing zone into this. So normally, like where you open, we look to see if you close in the same spot. It opened. This is considered an illiquidity pocket, so it's illiquid in here. It's going to illiquid close, so it's probably going to move really far, really fast somewhere. But this is our kind of area today, so it's interesting to see if res is less than 0. All up in here, right? So if you think about it. Res is greater than 0. It can move up to there, but you have resistance already here. So it's kind of one of those things. And then the ASDD band is right here as well. So you're going to have a little bit of resistance in this area as well for DD band. So unfortunately today, it's probably the best I'm going to hope for. And that's kind of a similar boat, mean reversion inside of here. As long as resilience stays positive, it does support there. Opening below hedge pressure, so it's likely not to break hedge pressure for long and stay out. See, Nasdaq is hitting its resistance, just like the S&P would hit its resistance there. So this isn't the best sign in the world for upside. The market's gonna probably play around a little bit. Now VIX is trading lower. This is something I do want to see. There's really nowhere to trade off of, which I don't like days like this. We want to see that VIX in decay though for the next couple of hours, so we'll see if that works. Now I do have to make a trade because I have to test a few things out. Not that I want to make a trade in this environment, but I need to put in a couple micros because we're still testing out some things. Okay, so we can sure everything comes in good. Okay. How do you bring futures up in RS? You have to be in Pro Plus, and we're about to release it to the public in just a little bit this week. So hang tight for one second. I'm going to take a quick break. Talk to my dev, and I'll be right back. The Pro Plus package you have to upgrade, and the futures will be released hopefully today. All right, you guys, I'm back. Try something. Are you guys sorry about that? The music's soothing and it's raining out. Oh, dude, I love these like lo-fi remixes of stuff. It's like one of my favorite types of jam music when I trade. Well, I mean, when I trade for you guys. When I trade here in my room by myself, I listen to like hard rock, metal, like deep house music. I listen to all kind of crazy stuff. But you can't really play anything you want on YouTube. You'll get like copyright strikes. So five length. Did trailing on Apex have to build up that drawdown now? Yeah. So anytime you're doing, yeah, and you have to be careful with those trailing accounts. You have to very much read all the what do they call it, like the fine print. So with the trailing drawdown accounts, a lot of the times people don't realize this, but it includes your high of the day. So an example is if you made a trade in the market, like Friday's a good example. It goes up and at the end of the day sells off. And say that you bought something and then you went up 4,000 and it sold off and you're back to neutral. Then you lost another 1,000. So you went up 4,000 and then down 5,000. Your net was -1. Your drawdown is trailing, so it would be 5,000 of the drawdown. So a lot of times people don't realize that if you go up and go down with an open position, that the open position high also counts in some of those, as I read from some of the rules in there. So keep in mind that you always have to pay attention, because you wouldn't know. You would just wake up and say, here's my active trade. You wouldn't know what your high of the day was while you were trading unless you marked it down and paid attention. Does that make sense? So you have to always be aware of, in the morning, not only what your starting balance was, because like a static balance, you know exactly how much you're going to lose, or how much you can lose before it counts as a loss. The trailing ones, some of them are really good, and I hear that some of them report like your active, like they give you a graph to show like exactly where you need to be. But you always need to be aware of, if you're trading these accounts, where your stop point is. So while you're trading, an example is if you're in a position and you go up $2,000 and then it starts trading out, you must always be aware of where your high of your account is. So if you're not paying attention at your active trade, think of it like this. You're in a trade. Normally your gauge is your balance. Say you start off your balance as 100K, right? This is like normally when you're trading. And you enter a trade, it goes up, you're like, oh, cool, I'm at 102K. Great, I'm making money. And then it comes back down, and you're like, oh, okay, 99K. Your only physical cue on your chart or on your platform of where you are is that you're just down 1,000. Your profit would say like minus $1,000, right? But according to your trader funding program, depending on how the rules are, if it's a trailing drawdown, it will account for your high of the day. And usually trading platforms don't report your drawdown for the day unless you go run a report. So an example is your P&L might show minus 1,000. Your trailing drawdown might be -5, and you'd be like, oh, I'm fine, I'm only down 1,000. But your trailing drawdown is still technically 3,000, because it does account for your open position high of the day. So open positions do move that marker sometimes. So anytime you're doing, the whole point of this is anytime you're doing a funded program or something that has metrics that are looking at that type of behavior, trailing drawdowns and things, read the fine print and make sure that if that's the case, and you must always be paying attention to that. So keep a sticky note or keep a spreadsheet or find some way to know what your high of the day position was, so that you know where your moving target is. Always the reason I'm saying that is, no matter what you're trading, always be aware of where your blowout points are in a trader funding program at all times, and where that moving target is. Somebody says that's the case for Apex. So trailing drawdown, sometimes it trails in the off the high of the position. Some of them specifically are like end of the day trailing drawdown. Like for instance, ETF has an EOD trailing drawdown. So they mark your account at the end of the day. So it's how much you trail off of the end of the day. So the intermediate part of the day doesn't count, if I'm not mistaken. So your high of the day, low of the day, that doesn't matter. So depending on which company you go with, you have to always read those rules. And there's typically 3 different kinds of accounts. There's a static drawdown, which means below a certain point, you're out, no matter what. Trailing drawdown is a moving target that follows your account in some way. Either it follows where it's marked end of the day or marked with open positions, highs and lows. So each one of them has very slightly different rules, but that's how they all stand out. Like each one of these companies, to try to compete for business, tries to create like a different way to do it. But there's basically those 3 ways. All right, friends, smash that like button if you can while you're here. Let's analyze the market and take a look at things. Now, I do like what I see today. It looks like we have fixed the double dom problem under the circumstance of unclicking show between bid and ask. It doesn't do that. I'm just kind of making a couple more notes for. So futures is very close to being released. I love it. So little by little, it's coming through now. One of the reasons why there's been a delay at the launch of futures for us. Okay, we are back in the mean reversion area of here. Let's take a look at the resistance on Nasdaq real quick. Okay, so Nasdaq resilience less than 0. My phone dead. I heard Elon pushed an update where spaces can now be done from your computer. This is a whole different thing. This is changing the game, because back in the day, you couldn't do spaces on anything other than a phone. I've been draining my phone battery doing spaces, and if you can listen to it on your computer, but you can't talk on your computer. So we had to play all these like phone tricks to use 2 different phones to get on the spaces. Rocket scooters on one, Matt's on another, with all the different spaces I'm on. Phones are in different rooms, they don't pick up feedback. Ruining your battery. Ugh. So now you can actually do it on a computer, which is great. Because you guys remember when I would like mute the mic here and then have to turn the mic on there and I'd be talking to different places. Now I could be active and live right here on my computer and not have to turn my face, which I love. Is the liquidity map for SPY correct? Ah, yes. Okay. So let me show you guys one of the nuances of illiquidity pockets. We know here this is a liquidity pocket, right? So everybody pay close attention to this. This is a bull zone and a bear zone here, and a bull zone here. Okay. So one of the things we do know is in the liquidity pocket, it's not bearish, it's not bullish, and so both bulls and bears are upside down in the middle, so it kind of balances the middle. Notice how the middle is rejection. Okay. Illiquidity pocket is when they're inverted. So some of you new folks here. It's the opposite. Liquidity pocket is neither bullish nor bearish. Illiquidity pocket is both bullish and bearish at the same time. So trading in the middle, bulls are in the money and bears are in the money. Do you see that right here, Colin? I'll teach you guys something real quick. So IP, everybody's winning from the house. LP, everybody's losing to the house. The difference as calls and puts being in the money. So here, all these calls are out of the money here. All these puts are out of the money there. So all the bulls and bears are losing in a liquidity pocket. Illiquidity is a period where there are some calls in the money and some puts in the money. And now you have winning traders against the house fighting against it. The markets are very violent inside of illiquidity pockets and very tame and mild inside of liquidity pockets. Great example of what you're seeing today. Like markets just kind of moseying along, and all of a sudden, once you're down in here, you see how rapidly it falls to the other side. Liquidity pockets love the middle. Illiquidity pockets, I hate the middle. They hate it. It rushes away from the middle as fast as possible, right? So in an illiquidity pocket, because it's both bullish and bearish, our algorithm makes a judgment call. If you are below the halfway point, it's considered bullish as well. If you're above, actually, if you're less than or equal to, so let me draw an inclusive dot there. Less than or equal to the middle, it's considered bullish. Greater than, it's considered bearish. Here is considered mean reversion. That's how the algorithm pans it out. So when you're on the bottom side, it'll flip. See, I'll just flip from bullish to bearish. Does everyone see that? To answer your question, Colin, you got it? You got it, my man? Because it's both bullish and bearish at the same time, the algorithm has no indication of which one to show you. So the way that we determine it is that if you're closer to the bottom, it's considered bullish. If you're closer to the top, it's considered bearish, just like this. So in this particular sense, does this make sense to everybody? It's both bullish and bearish at the same time. It tilts the scale. It'll be more bearish when you're at the upper part. It'll be more bullish when you're at the bottom part, because you're right, because deltas are going to be, or gamma is going to be the highest. So the algorithm makes a decision off of those gammas. For an example, right here, the gamma at 449 is much higher than the gamma at 448. So therefore, 449 would produce more pressure than 448 would. So the bear side would essentially have more pressure. So it's really interesting how we decided to do that. But we ran a whole study and a thing on why that is. But that makes sense to everybody, right? Even if the liquidity pocket and the half gap are completely unrelated to each other. So you have to look at those two things separately, Luigi. That's a great question, though. So ignoring earlier what I was saying, just ignoring half gap and redistribution zone. So as price is moving through here to here, let's just draw an example. Price moves from here to there. This is what the letters will show. It'll be BR up to and equal to that. I'll put a dot for inclusive. A closed dot for inclusive. An open dot for exclusive. So inclusive is BR. Anything inside of there is MR. Anything from there to the middle is considered bull. We include the middle in the bull side case. We always tie break to the bull side, simply because the market's always more bullish than bearish. That'd be considered BR. Again, inclusive to there, and then that's considered MR. That's considered B again. See how right now it's BR? As you're here. And so it becomes, so that's basically how you note it. In reality, the liquidity map flipping, it's not even actionable, because in BRSU, the only action points are on hedge pressures anyways. So you're not even at an actionable point. It's just to let you as a trader know that the pressure from here generically is resistant. But there's nothing to resist off of. See how there's nowhere to trade off of? That's something to take note of. So it's bearish. It's in its mean reversion in here. It's bullish to the middle. It's bearish to the middle. So it shows you is that like at the lower half, it's just going to try to push off of here as support. At the upper half, it's going to try to push off of there as resistance. And that's exactly why we did that. You see that? From down here, it's going to try to push away as support. Up here, it's going to try to push away as resistance. You see that? And fly through the middle. And this is a great example yeah, there's no action points to trade off of today. There's nothing to trade off of for me. Now, one may use Nasdaq as a proxy and see that while we are trading through illiquidity pockets in the S&P, the Nasdaq is providing 374 resistance. And even if there is a break like there was today, the attempted move is to 375, and it's really not much we can take from this at all. This is likely to be a flat, choppy day. Could I try scalps in there? Could you try scalps in there? Yeah, there's tons of ways you can scalp inside of illiquidity pockets, one side to the other. It's always a scalp range, but nothing today is providing any kind of love. Not yet. But that's okay, right? We want to see the market. The market's not going to be extremely reactive to the upside, and especially trading below hedge pressures. But we're going to see where those possible points are. Like Nasdaq is looking like it's attempting. So if the market does continue to go up, it's going to be rallying inside of a bear market. So now look at something today, right? Now this is another thing that talks about healthy breadth of the market. So normally, as we've rallied on that tech boom, right? And some of the blue chips have rallied as well. You want to see that small caps are getting just as much love at some point as well to have healthy market breadth, right? Markets don't just rally on a couple of sectors, right? The S&P kind of following those top 7 tech stocks. The Nasdaq moved first. The S&P started trailing higher, but the Russell hasn't made its move yet. The market still has not put its faith into small and medium cap companies, right? Russell's still kind of fighting. And so the question that you're going to have, especially in this environment, is where is the appetite of risk for the firms and funds? And right now we have to make sure we monitor in the Russell. As we're not seeing the Russell gain momentum while everything else was, this is a clue that the market is not as healthy as you would expect it to be. Hold on. Those of you that trade with TradingView, is there a feature, because before I go explore it, that not the lock button locks the DOM where you click it? Is there a feature that auto centers the DOM somewhere? Because what we have to do is we'll have to see if we have that. I'm trying to instruct my team. A feature that the active traded price floats in the middle, right? It's like the lock button locks it. Or does the lock button auto center? Is that what that is? Disable dynamic mode. Okay. Let's see if that does. Does this, if I lock this, if it goes off the chart, does it go off the chart? So anyways, what I was saying is that the fact that the Russell has not picked up steam is that the bulls are more cautious than we anticipated. You know, what you wanted to see is you want to see, now let me just kind of go to, let's look at monthly maps. I kind of got to do that really quick. You know, you want to see obviously people moving from tech side and the hot stuff. You go into the things that you know are more stable, at least for your equities appreciation. And then you roll into less stable or riskier things as your appetite for risk grows. So the appetite for risk was people jumped on the trend and nothing else really is rallying with it. The trend of tech, big tech moving higher. NASDAQ kind of pumped up to here. The S&P almost made a double top and the Russell never started moving. So it's kind of like people dip their toes into the swimming pool, but not necessarily are the firms and funds running all in long on all the stocks. We didn't get that movement in Russell. So to see some movement in Russell as you're seeing the hot stuff pull back, you want to see the Russell be the thing that moves up. If people are taking, if it's just like, okay, people are taking profits in tech, now they're going to start rolling out and buying Russell because it has a lot of room to move. If the market's really, really bullish, exactly what they'd be doing. You would see active, healthy divergence as people roll out of some of the sectors that are overbought and rolled into some of the things that were depressed. And so the Russell being that thing that hasn't moved yet, it's the obvious thing that could go up. It's the thing with the most room to go up. If everything's supposedly super bullish and going to double top, the NASDAQ, the QQQ, SPY going to double top, then obviously you would see the Russell starting to go with it. And so we're not getting that Russell move. So the idea is if this market is actively sustainably bullish and we're still going to rally off of mechanics of people are just really bullish and not giving up, you're going to start to see the Russell being the one that has the momentum as the S&P and NASDAQ are stabilizing. And so right now, don't lose sight on the Russell. As a matter of fact, I'm going to leave it here. If that makes sense. Hold on 1 second, I got some things to do. So the idea that we're not getting a lot of Russell love is another piece of evidence that people were just bullish for a year because there was movement to be had, but you're not seeing people still have active faith in this market. The economy, the economic data is starting to hint that we're pulling out of a recession, but the stock market always prices in the future. The stock market will precede that change in the economy. And so one of the things to take note of is while economic data is improving, the stock market already effectively priced that in. If the stock market's going to reflect any downside, it's anticipating that those bigger problems are going to leak back in. All the data is still, it's not strongly positive. It's just positive enough to show that we're out of a recession. We're leaving the recession. That doesn't mean that next year or two, high interest rates are going to pull us back into it. That is really the big problem, is interest rates and the ability for people to borrow money or banks to issue credit, right? As you might be reading on Twitter, reading in some places that the interest rate, like a 30-year mortgage rate is up, 3 or 4% in the last 3 years. Basically, there's a problem. And employment needs to go up to reflect the change in risk. Now, with a higher interest rate, it's harder for people to get that loan if the unemployment data looks weird. So as the employment data is getting better, as interest rates are going up, it's not necessarily, it's bad, but it's not like doom for the housing market if the risk of that borrower goes up at the same rate and people's wages are going up the same rate. Well, inflation is one way that interest rate is taken care of, right? We still have a little bit of inflation. People are still able to make a little bit more because of that on paper. So the risk models of the banks count that in. What's the probability this person can pay off that principal over the period that we're looking at? And if the Fed's fighting inflation, which is going to bring wages and everything down, and that interest rate for mortgages stays the same, then it's riskier to lend money. And that's why people are saying there's potential credit events coming around. We were talking about that earlier in the year, and we were saying that's not in the near term. That's like a 2025, 2026 thing. If you remember anything about the housing market, it moves so slow. People aren't going to default and all of a sudden this housing market's going to crash again. First of all, there's no bubble. Inflation's making it hard, but people aren't necessarily getting laid off as fast as they used to be. The employment data is getting better, so those risk models are looking better. The chances of people paying off those loans better, but they're going to have less money to spend. So not only is inflation still plaguing the economy, high interest rates plaguing the economy, it's going to keep things. The question is it going to slow things down or just stop things from speeding up so quick? Right. So the question becomes timing. Is there like a looming credit event? I think that's absolute nonsense. The market's not gonna do anything today off of that. It's gonna take years of what's inflation doing. I mean, the mortgages are high. $500,000 house, your mortgage is probably around 200,000. Or sorry, your monthly, your mortgage probably low 2,000s at the current interest rate now. It's probably low 3,000s, right? So people's house payments are up 30 to 50%, and that's a stretch for a lot of people, especially people who bought on the high principles after COVID. And that's a mass production era where people were just jumping in and producing things really rapid and really fast. So those houses are even a complete dog shit too. They're not even like well constructed. They were mass constructed things in COVID, right? People would buy materials wherever they can find them. So these shoddy materials. It was hard to find good labor, so you took who you can get. So everybody knows if you bought a new build in the last year or two, it's likely plagued with a lot of problems because it was made quick with cheap materials, with whatever labor was available. Instead of what people normally do, their streamlined, efficient process. There are people trying to produce houses so quick to get on the boom. You're buying a pile of dog shit for very expensive with the high interest rate. This is obviously a time zone problem here. We need to repair that. So the question is, when does a credit event become an issue? Obviously, a credit rating downgrade is not the same as what I was experiencing. That has to do with, the ability for us to borrow and pay back our debts. And even though AA plus is still excellent, it's not outstanding, right? It's like the equivalent of having your credit score go from like an 830 to like an 815 or whatever. You're still AA plus. I mean, everybody's like, oh my God, market's going to collapse on that. It's just because the United States is known for having pristine credit rating for almost the entirety of its existence. Pristine, as in like we're the most worthy borrower on the planet. We always pay back our debt. We can borrow as much as we want. Everybody will loan us money, kind of thing. And so having a credit rating downgrade in the middle of QT, those are two things that should always stick in the back of your mind. There is a valid bear case, even though we don't believe that's happening now. The bull case is still so strong. Now, the bear writing is on the wall. It's just not going to collapse the market. Now, the bears right now are absolutely wrong for right now. The market sold off right now, yes, off of that kind of thing. But that kind of thing is not pointing at something that's going to happen right now. That kind of thing is pointing at something that's going to grow into a bigger problem. There's no bubble to pop other than tech stocks have boomed, and that's it. That's it. The equities market is still strong. The liquidity is still here. But QT, number one, is the Fed letting assets roll off the balance sheet. The Fed's not investing in the faithfulness, or there's no faithfulness. Fed's not investing in the U.S. markets and bond markets and things like that. That's what QT is. The balance sheet is lessening. There are fewer things that they're holding. And with the lower credit rating, that's kind of like two hits to the ability for giving some adequate value to U.S. debt, right? The Fed doesn't want it, and other borrowers might not want it. I'm sorry, other investors might not want it because, well, I mean, if your credit rating is downgraded, then it's just like your credit score lowering. The chance of your default goes slightly higher. So clearly, that's a sign. If the Fed doesn't want in, and there's problems elsewhere, that's a sign for longer term issues, right? Longer term issues. I'm talking years out. Bears love to hear every bear piece of news, and then immediately, aha, sky's gonna fall. But see, the thing is that fundamentalists aren't traders. We don't care. We just actively understand what the future looks like. The stock market slowly prices in the future, months to years in advance. So the question becomes, is that a problem now? The answer is hell no. There's nobody's going to notice now. Houses are still flipping very rapidly because the limited supply. People are still able to get the loans. But if unemployment numbers start to show people are getting laid off again, you're going to start to see those problems, right? So you need to start to see those numbers change to be like, aha, this is the reason why. As long as people are going back to work and the jolts are coming down and unemployment filings are going down, means people are actively going back to work, then obviously they have an adequate salary to cover what their expenses are. And while it may be a little bit more of a stretch for the average American worker to pay off 7% where the mortgage rate is now, that's a lot. It's really high. A 30-year fixed rate. It's still not bank breaking. Your pocketbook is a little thin. Like I remember when I worked as an engineer, and my salary was always between like 100 and 150 a year. Your take home on that is after taxes, $10,000 a month, give or take, right? Something like that. Your difference between a $2,500 mortgage and a $3,500 mortgage is $1,000 less. I mean, you weren't living paycheck to paycheck as a person with a six-figure salary. You just have less money to go blow on luxuries at the end of the day. So the problem is not enough to stretch a lot of folks. That issue is going to be really hard for middle class and minimum wage earners. That's going to be the problem. That interest rate change may not affect somebody in the six-figure salary range. And interest rate change will certainly be very problematic for the spending power of a working family where both working members of the family are minimum wage. And that's a lot as far as your take-home pay is concerned, because you might just be right on the edge there. Leisure and hospitality may take a hit, and that's kind of what is the thing, and that you have to think about it. Well, we have the big tech boom. We're not seeing the Russell and other things move up higher because that's actively being understood now, is that inflation still being a problem is still going to affect the spending power of folks. So you're not going to see all the stocks moving higher. If we understood that the American dollar could spread out into leisure, luxury, consumer discretionary, you would see the appetite for, this is the whole reason I started this conversation, you see the appetite for the smaller cap or medium cap, higher risk companies to be there, and it's just not there, right? It's being understood that inflation's still an issue. The Fed is still committed to raising rates until it's fixed. And when they say inflation's still an issue, that is the issue. Is that if, now the question is, it's not something that is going to be an issue until people start getting laid off again and defaults start happening, which you're talking about 3 months minimum. Just for, if you got laid off in 3 or 4 months, then you start to get phone calls, right? And then after the lawsuits and evictions and all the things happen, the problem doesn't manifest. If there were massive layoffs like starting today, you wouldn't see, while the risk model would change immediately, you wouldn't actually see those problems realized, foreclosures and all that, for 6 months or more. The whole point of like, okay, there's problems right now, the market's going to collapse. It's just not exactly how it works. It's always a timing. As a trader, timing is what you do better than other people. Your job is to guess the timing. So right now, there is no bubble, A. Number two, there is no housing problem yet. Is it harder to get loans? Yes. Are people having to pay more? Yes. Are they going to go bankrupt paying more? Probably not. If you're in the market to buy a new home, you've got 5, 10, 20% of that home's value, even at the inflated price. This is what the bears understand. They want to hear half of the story. Imagine you want to buy $1 million house, okay? And I'm going to use the example that you're the kind of person that wants to put, let's even use the minimum example. You want to put 5% down. Let's make it easy, 10% down. You're the kind of person with $100,000 of spending cash, okay? While your dollar doesn't stretch that much, the bears are not understanding the point is that you're the kind of person with this much money in your bank account or assets that are liquid for you to be able to tap into to have this money to spend on that house. While inflation is plaguing you, the fact that houses are still flipping around, you're like, well, they got to pay a lot of money for their mortgage. It doesn't matter. They're the kind of people that would have this money sitting there. They have the money to afford the inflated mortgage. And that's why it's not a problem today. And this is the whole point of my thought, is that you have to understand that, yes, there's going to be a problem with interest rates, but it's not going to realize today. It's not going to realize now. If people are buying the house now, they have the cash to spend there. The difference on a $1 million house, your $5,000 a month mortgage goes to $7,000. You still want that $1 million house. I don't know, whatever. I did the math in my head there. $2,000 a month isn't going to break you if you're the kind of person with $100,000 to tap into, unless you lose your job. And if you lose your job and you didn't have any more money, then the problem becomes a problem for you. If you can't afford it. If you have another earner in the family, you might be tight for a little bit, which would affect your spending and discretionary items, which you want to default in your house. There's no housing crisis about to evolve immediately from this effect. I know this because I'm shopping for houses in the $1 to $2 million range, and I can't get one on the market fast enough to actually go see it. We're actually looking in other cities, not just Houston, to expand because it's hard to find stuff anywhere. So we're looking here. Everybody knows I got a new house last year, but I'm looking again. Something bigger, more space, obviously, at this point. And, you know, with the prices the way they are, clearly to get, you know, the house that I want to get something like 3,000 square foot, 4 or 5 bedrooms, you know, something like that. Not stuck in the burbs, but not like deep in the heart of the city. We're in the 1 to 2 million range, no matter where you look. So we're looking like in Dallas, which is 4 hours away from Houston. Plus Nicole's family lives there. Just to also expand, and something shows up and we're like, ooh, let's go out to Dallas this weekend and look at it. And then it's under contract by the weekend. Like, we can't find in that price range. So again, that's the price range that's not going to really, like I said, those are the people that have the money to spend, like myself. Yes, interest rates are terrible right now. Yes, it'd be probably a terrible time to buy a house, but then I got to wait 2 or 3 years for that problem to fix if I do want a house. So it's kind of like, what do I do, right? That's the question. So I'm not looking in the range, because personally, like, I'm not looking in the range of like 200 to 600 to see what's happening in that world and if those houses stay on the market or not fast. What I'm telling you is that people are still getting loans in the 1 to 2 million range, and the houses, a good one comes up, and then a couple days later, by the time we were like, oh, let's go to Dallas, can't. So we're having like her sister and other people that live out there literally go out there and look the moment that they're in there, and they're like FaceTiming us with the walkthrough because we have to move quick. So it's like, it's not a problem yet, but the problem could manifest. So people are still able, and that's why I'm saying if people are buying houses at that range, banks are lending out that amount of principal. Pretty much everybody in her family, that they all own 5 to 10 houses each. That's what a lot of them do. That they buy houses and lease them out, and so they're actively flipping houses. I'm sorry, buying houses to rent and getting loans as well. So it's not drying up the market overnight. It's in a weird situation now. Again, I haven't investigated, like I said, the 200 to 600,000 range, because that's where the dollar, your dollar is going to be a little more impacted. You're going to have less. It's the smaller, or sorry, the lower the principal. I need to, basically I need to investigate just to know in that range, our house is just sitting there and not getting bought up. Like, what is the willingness for banks to lend money? That's the real question in this environment. The problem is not the problem. The problem is your attitude about the problem. That's the problem. That's hilarious. So the question is, when you start to see houses just sit there on market 30, 60, 90 days, people are trying to sell because of some problem they're facing and not able to sell. Once you start to see that, we go from what's now a supply shortage to a supply abundance, right? And then you'll see the banks aren't going to be lending out as quickly. We're not seeing that yet. We're still seeing growth. So that's good to know. Oh, Thomas Robinson says, agree on your thoughts. And this is, again, just from my personal experience, and only isolated to like the range we're looking in, which again is 1 to 2. Even like, actually, we've been looking at some of the mid-century moderns that are pricing in like the 800 to that 100,000 to 1 mil range as well. Those are flipping as fast as possible. So I would say that like my personal experience viewing the 800 to 2 million, they hit the market and within weeks somebody ready to buy it. In Dallas and Houston. Now again, Dallas and Houston are the hottest real estate markets on the planet right now because they're super cheap and everybody's moving to Texas because of that. Now that's isolated to my own view. Real estate investor Thomas, maybe you can tell me, like you said, you're a real estate investor and the middle market is extremely tight. So I would say is that like outside of Houston and Dallas, maybe something that's not like one of the hottest real estate markets out there. Like ignore Miami, ignore Texas. What about other regions? Like, I could just be living in the Texas bubble. What's the middle market and even the luxury market like in other states? Kind of on average. Do you feel like it's slowing down? North Dallas homes are crazy. Live in a 5 to 800,000 home neighborhood and houses stay off the market around. At KB, that's where actually we're looking. Highland something, Lake something. I can remember what it's called. What's that neighborhood called? I always keep forgetting. My brain is still I'm not gonna lie, I'm still Lake Highlands, that's it. Highlands, Lake Highlands, yeah, that area. That's where we've been looking. Mostly that area. Lake Highlands, Casa Linda, Lakewood, that area. Highland Park, that's it. That's the whole area. There we go. It's all pretty much similar area, yeah. So that's one of the places we might end up. Upper DD band tapped on the S&P right now. That's looking pretty solid on my little 2 micro trade. Your girlfriend just put her house on the market outside of Nashville and got full price offer on the first day. Easy. Highland Park is the SMU area. Oh, nice. It's just family that lives kind of in that area. I would make it equivalent, those of you Houstonians, it's very equivalent to like I wouldn't say Westview. It's not as high a price point as Westview. Westview in Houston is like one of the highest median income areas in Houston. It's more like, I would say Heights. What's it called? Like Garden Oaks area of Heights, like Northwest Houston. That expanding kind of growing area, which is cool. It's like hot, expensive, but not like River Oaks expensive. Just moved to Kansas City. Oh, hell yeah, dude. Let's go. We move to Kansas City. Be nice. All right. Let's analyze the monthly maps. We need that real quick. All right, QQQ, as you see, like, this is the thing, right? Look at QQQ. Bull zone's still hanging in there. Bear stones still whittling away. This is a short-lived event. I like this. I'm actually not unhappy about this at all. This is really short-lived and nice. I do like what I'm seeing. Look at this. QQQ rescued itself. This is actually really good for the market. Looking super hot. I don't need that tooltip there, right? QQQ is done caring about this event. Y'all see that? Bull side stronger, bear side weaker. This is a good sign. Let's see what SPY is doing. This is still very bullish for Qs. So it's good to see that this is a dip that people have appetite for to buy still. The S&P back to business as usual. Ashton, you see this, right? I figured, yeah, I mean, honestly, it's just looking hella good and hot. I like it. I don't dislike it. There's your Russell bounce. Let's get off of here. Clean, right? It's like, this is the dip to buy. This is great. This is like on the longer term thing. I'm super excited about it, to be honest. I can't disagree. I can't like hate what I see, right? How's my 100K challenging? I haven't really been doing much in it for the last, month, 2 months almost. It's just paused because right now my goal is to get everything in futures and rockets here loaded. So the development of the platform to do trading here, so I can do trading here instead of there, has been like the most important thing in the world. Yeah, but the crummy thing about my life is that it was so much fun. The first little bits of starting to develop the platform and build out what we built. Now it's, obviously we're a company with 23 employees. We're building fast. We're building features. My life is filled up with meetings. I mean, I'm an active CEO of a corporation. Now I don't get to just wake up, trade, go back. Every day I can just have 2 or 3 hours, block away, trade. Like if I only had one job called trader, it'd be great. I can actually actively do that. Now it's like I got to build out the futures thing. And this has been a project that's been going on for like, 4 months now? And so every day, plus all the bigger things Ash and I are working on, our whole our whole life is dedicated to building the platform now. So I don't get my every day to wake up and focus on my challenge. So the next step is to get futures trading fully launched here for you guys. And then I'll actively pick up futures trading here. But focusing on a challenge is going to require my full attention to focus on the challenge, right? It's not easy. I'll just be straight up with you. It's not easy to just wake up and focus on the trading I need to focus on when I got to do 10 other things. So that's kind of the downside. So I'll pick up futures trading in our own platform. I kind of want to pick up the challenge at some point when I know I have nothing else to do but focus on that. You ought to realize how hard it is to pay attention and trade on top of building a platform, on top of being on 2 podcasts at once, doing a stream at the same time, and then answering customer service questions, running a massively growing company with, that's expanding and hiring people. It's become like, I miss being a trader where it was just a trader, but I love being a CEO. Rock Scooter. So you have to remember when it comes to me and doing what I'm doing. Difference between myself and, say, like, I don't know, pick your favorite trading guru out there who built a tool, and then all I do is trade and try to sell subs or memberships. They're not building anything anymore. They build something, they're just selling it. So Rock Scooter to me is a 16-hour a day job every day now. Can we restart the challenge? I just pick it back up where I left off, but I transfer everything to here in Rocket Scooter. Now, it could be a cool publicity stunt to restart a challenge here and just use Rocket Scooter trade. Obviously, right now, our own platform is going to take precedent over Tradeovate. Unfortunately, I'm no longer going to be using them to trade with. But if I restart the challenge, that's all I'm going to do is focus on the challenge. And I think, like, later this year, it'd be a good thing to do. I still want to finish the other one, but I can't finish it in Tradeovate because they're now actively our competitor. So obviously, it wouldn't behoove me to show their product on my stream anymore. I must show our product. So when I get, here's the projects we're going right now. The futures being launched with the CQG connection, and our broker partner is literally launching today or tomorrow. After that, we're going to get automated DD bands, risk intervals. We're going to work on all the automation for the remainder of the alerts. After that, we're going to have a Rhythmic connection open up. Our active partnership with a trader funding program will also be available, which means you guys will get a discounted rate to trade that trader funding through Rocket Scooter. Huge change. We were trying to do something like that earlier in the year. We just weren't, there really wasn't some synergy at that time because you couldn't trade in our platform yet. So that synergy will be there soon. So after we have our CQG through EdgeClear. So EdgeClear is our partner broker, by the way. So you will see this on your connections tab when we launch it. It's not launched to anybody but myself at this point, so you can't see it. But we'll have, the next step is to do a Rhythmic connection. So all of your trader funding programs that use Rhythmic, and everyone has a Rhythmic option for the most part. I think ETF has one. I think TopSup has one. I think Apex has one. So no matter who you trade with, if you have a Rhythmic connection, you could just log in right here and then run your trader funding program through here. Shut up. Ralph, there's no such thing as a trader who builds a platform anymore. Building it, I'd love it to be that. You nailed it. I'm a trader who's building. I am a trader that's building a platform, but my job focus is that the 2-3 hours a day that I like to spend trading is in the middle of business hours, where 16 hours a day I am having to be the developer. And unfortunately, it sucks, but I don't hate it because I love building the next generation thing. I mean, we're the hottest trading platform on the planet right now. We're growing stupidly fast, and everybody's hearing about Rocket Scooter and coming to check it out, which we love. I love doing everything for this project. It makes me happy doing something I love. Tom was a trader, but definitely kicked way harder from building those businesses. Well, yeah, I mean, he's stupidly wealthy from that. When the commission's like through Edge Clear, you can go when we launch it. They'll have information on their site. Commissions aren't too bad. Now, one of the neat things I love about Edge Clear and using one of our partner FCMs with them. Listen, I'm not gonna lie. I love Tradeovate, but I think it's dangerous to give futures traders $500 contracts. NinjaTrader Tradeovate has this intraday margin that they hand out to traders, and basically it's like designed to make you trade more, which means they make more commissions because of your stupidity, and you blow up faster because you're over leveraging. We're not going to be giving you, we're not going to give you $500 contracts for S&P and NASDAQ. That's for newbies who don't know what they're doing. You're never going to trade with that margin anyways. If you trade with that margin, you're already going to blow up. We train you to trade futures with the following equation. You take your net lick divided by the initial margin requirement. I'm going to make an example. If your initial margin is 10K and you have 50K in your account, then you'll be trading 5 contracts max. But if you're using your $500 intraday margin with the 50K account, Tradeovate would let you trade 100 contracts. We're not going to give you that $500 margin. So our broker is going to limit how much you're allowed to borrow and trade, which is exactly what you need, futures traders. I'm not going to lie. All the discount futures brokers give you $500 intraday margin for contracts. You don't need to use it. So we're not offering that. We're gonna be the smart group. Now don't quote me on this because I need to double check. Remember, I'm still on festival brain. Don't judge me. I was at Lollapalooza for 2 days, and let me just say I've been whatever my body ingested over the course of the last 5 days. You all go to music festivals, use your imagination. I'm still feeling all of it right now. So I still have mush brain. Yeah, we flew in, we got in at 2:30 in the morning. We literally partied for 4 straight days. It was an amazing experience. But I have to remember, it's either we're only offering either 25 or 33%. So if it's 10,000, I think it's 33 instead of 500. We're not going to give you that crazy intraday margin that Tradeovate NinjaTrader baits you with. Oh, you can only trade futures. You only need $500 for the contract. But you go in and blow up faster because they let you buy more. That's not what you need to be doing as a trader. That's not, to me, that's not appropriate for a new trader to have the ability to over leverage. That's dangerous. I'm not gonna lie, I do rage pretty hard. I'm pretty hardcore. Even at 41, I still got it. Now I gotta take my blood pressure medicine in the morning before I go rage all day, but still. In Chicago, clubs stay open till 4. That's crazy cool, because I didn't that's something we don't get in Texas. So it kind of had that Vegas-y feel. It was kind of nice. Talking about fucking blood pressure medicine. So I'm not getting like, and I get anxiety. So like, I've never, honestly, I'll tell you, I've been to some of the biggest music festivals in the world. I've never seen that many people as I did at Lollapalooza at a festival. And we piled out. I wish I had a video of it. When we piled out at the end of the night and dumped into the streets of Chicago, literally 400 something thousand people just piling out at the same time. The city streets, it looked like one of those riot scenes you'd see on like Instagram or Twitter right now, where people are rioting. Like the streamer had that riot in New York City. Kind of looked like that. Just that many people just packed in peacefully. There were no problems. There were no craziness at the festival, but it was like seeing that many people just walking through the street peacefully to get to their Ubers and whatever was kind of a fun experience. I was like, I get anxious around that many people. I hate people crowding me. I'm like, ugh. I'm like reaching in my pocket for a fucking Xanax. I'm like, oh. Just eat keto. Yeah, I'm actually eating really healthy and working out really healthy. And I've lost 8 pounds in the last 2 months. Aggressively working out once, twice a day. Getting my blood pressure naturally down. Laying off the energy drinks. Trying to stay alive. Lineup was pretty good. I'm not gonna lie. I enjoyed the lineup. Now it had a lot of bands that, like, when you look at the lineup on the surface, a lot of people would probably be like, that's okay. Well, honestly, if you like have a really expanded musical taste, it was one of the best lineups, period. And on the surface, it's like, oh, I guess some of those bands would be cool. I mean, sure, but let me show you who's cool. Let's see if I get the lineup here. Hold on. One of the best lineups I've been to at a hold on, where's the lineup? We only went for 2 days. It's a 4-day. Where's the? Oh, hold on. Oh, it's because the damn festival is over. Oh, they took it down because the festival's over. Okay, well, I get the new one. Old pictures. The lineup is amazing. In my opinion, the lineup is one of the best lineups I've seen at a show. If you like all kind of music, okay. Like we only went Thursday and Friday, so we didn't do Saturday, Sunday. But you saw Bon Iver over the weekend, dude. I'm gonna tell you, dude. This is one of my favorite bands. I love Bon Iver. Where'd you see him at? Justin Vernon is hands down like just one of the most talented musicians of our generation. That guy made that the debut album. The one that won all the awards. Not the debut. The Bon Iver album, actually, just the self-titled one. That's the one that won all the awards. Was one of the best albums of all time. Fucking great. So we saw these 2 days. Now the crappy thing was, you know, I'm not gonna lie. I mean, I'm a huge Kendrick Lamar fan, but I wasn't excited to go see Kendrick Lamar. I knew because I love the 1975 so much. So we actually, the funny thing is 1975 is great. They're fun live. But like the festival, you're all the way through like Grant Park, and it's like literally like a mile to get from one side to the other. And the stages are like this with all the other stages in between. So the headliners play on the bigger stages. So it's like you have to pick one or the other. So we actually watched like the first 2 or 3 songs of 1975, and then we walked to Kendrick. And there were so many people, we couldn't even get close enough to hear it. So we said, fuck it. And we went to go see Subtronics at the other smaller stage, and we just closed out with the EDM show, which is good. But some of the better bands, Billie Eilish, she was awesome. We saw her the first night. Yeah, Billie, dude, she was out of this world great. Like if you like all kinds of music, Lolla is like the festival you want to go to. We do a lot of EDM festivals, which I love. I love going and just having lights and sounds for 2 or 3 days. I'm that kind of person. It would go to like Tomorrowland, or EDC. But if you like music, I mean, Red Hot Chili Peppers. I mean, how awesome Lana Del Rey is. Like, they're huge bands, right? And I wanted to stay on Saturday to see like Odessa and Medusa. This was kind of like the day I wanted to stay, but we instead stayed we had a whole bunch of people that went, so we walked around and toured the city. Saturday night, we went to a bunch of bars and clubs and just hung out there. Now, who was great? Portugal the Man, like literally one of my favorite bands. Amazing. We didn't get to see Carly Rae. She's playing at the same time as someone else we were seeing. Didn't get to see Diplo because I've seen Diplo 6,000 times, and Diplo's great, but I was like, I see Diplo all the time. We actually watched New Jeans, which is like, I don't know, a teeny bop K-pop band. Actually was kind of fun. Never heard of them before, but Dom Dolla, always awesome. Timmy Trumpet, always awesome. Saw both of them. Who else did we see? And Billy. Saw Sophie for a little bit. We walked by him. Oh, Rima. Hip hop. So like hip hop, EDM, K-pop, Billie Eilish. Just like if you like all kind of music, they're like Lolla's like the festival for you. They got something for everybody. One of my favorite performances, 30 Seconds to Mars. They fucking killed it. That was, to me, I remember I walked up while they were playing Rescue Me. It was great because when they started playing, it was just such a cool feeling. That's one of my favorite songs of theirs. Subtronics, we finished off the festival with them. Sudden Death, missed him. He's a DJ because we were seeing somebody else. Saw a little bit of Biba Doobie. He's a lot of things. Didn't get to see full Diesel. Everybody knows who Diesel is. Shaquille O'Neal, if you didn't know, is a DJ, and Shaquille O'Neal is Diesel. And he spun a pretty badass set. It was like a mixed dubsteppy, hip-hoppy EDM together. So Shaq put on a hella good show, and we actually were all surprised not to see him. We missed Arm & Hammer, who we really wanted to see as well, because we got there too late. We're too hungover from the previous day. But yeah, it's like just a mix of all kind of cool stuff. It's really fun. Nina Geraci, that's the first time I saw her, and she's an Australian DJ, and she was really good. Her show was pretty good. Then we saw 1975 and walked across to see Kendrick. So it's like if you like all kind of music, and I went to see the Foles too. I've seen them a bunch. They're like a indie band, but we didn't get to see those because it's like you have so many options, and the people only play for like 50 minutes at a time. But Red Hot Chili Peppers would have been fun if we would have stayed till Sunday to see them. Obviously, I've never seen them before. Obviously, we had a kick-ass show. You saw Diesel, Electric Forest. He was a lot of fun, right? It was crazy. Like when Shaq got on stage, there was like some kid from the audience like jumped up on stage, and Shaq put him on his shoulders. And we were far away, so we couldn't see. But you saw like basically it was like this. You could tell it was Shaq because, you know, like pretend like this is the stage, right? And I'm like way out here a million miles away. You can see like there's a couple people standing up there on the stage, but then you saw a head that was like here. So you're like, yeah, there's definitely a giant man standing there. You could see it from a mile away. And then there was like a little head above it. So somebody from the audience was like sitting on his shoulders. And it was such a Shaquille O'Neal kind of thing. Nothing happening in the market right now. Just chit-chatting. Monthly maps look really good though. I'm liking what I'm seeing. We hit the upper DD band and the S&P, so day's over. I'm just rapping about my trip. Market's solid though. Everything is looking solid today. S&P resilience is positive. We hit the upper DD band. Like I said, that's probably just the end of the day. There's not a lot to say from here. As a matter of fact, I'm just going to flatten the trade out. I was just testing a trade. We're still testing a couple things. But I was wondering, you know, I was like, okay, it'd be fun to see Shaq, and he was energetic, was good. You see him, put your hands up. You can hear him like really far away. He's got that. His voice is pretty cool. He's got like that. When he's yelling and screaming, he sounds like Cookie Monster on crack. Ladies, put your hands up. And we're just like, oh hell yeah, dude. Boom, 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 boom. It was fun. It was one of my favorite DJ sets. I wasn't gonna lie. He spun a lot of bangers. Like, he doesn't write his own music, but you were like, he spun a lot of good bangers. I had a lot of fun. Kendrick's great, not too excited. Yeah, that was my thing. So we had a vote, like, and it's funny because all the girls want to see, you know, Kendrick, but there were 3 guys in the group, and me and 2 guys, another one of the dudes were like the organizers of the trip, and we're huge 1975 fans. They're like an emo indie rock band, and the lead singer dated Taylor Swift for a little bit. He drinks wine from a bottle on the stage and smokes cigarettes on the stage. Very like that showmanship of like being like the depressed soul. Like, and the ladies is like, he's a huge fan club of girls. And the guys were like, we should go see 1975. And the girls are like, no, let's go see Kendrick. We don't like indie rock. And we're like, no, 1975, they're so much fun. So the compromise was, because I was like, you know, Kendrick's gonna be packed. I mean, he's obviously one of the biggest artists around, and we're not gonna get a good seat. You got to pick one or the other, because if you walk from one to the other, you're gonna be lined up so far away from the stage, you're not even be close enough to hear it. They're like, oh, come on, let's go see it. And we got there, we were so far away, you couldn't even hear the music. That's how many people were there. People were like, yeah, like the girls want to see Kendrick, the guys want to see 1975. We're such softies. It's so funny. We want. But I think they're great. I think they're like some of my favorite indie bands that are like indie pop rock, like 1975, Walk the Moon. They all make really good music. Sing along songs. I'm gonna say one of my favorite performances is probably 30 Seconds to Mars. Like, they just killed it. Their sound is big. Like, they have that huge sound to all their songs. And the showmanship was great. That's actually my first time to see them too. But I was like, yeah, Kendrick could be fun. I mean, I love Kendrick Lamar, but like, I feel like this show would be kind of mild. You know what I'm saying? Like, I'd be like, eh. Like, if it was like Drake or somebody, yeah, I would like fucking crawl my way to the front to see Drake. Kendrick Lamar, I'd be like, yeah, I love all his songs, but I'm like, I feel like I'd have more fun at 1975. That was our argument, and so we decided to cater to everybody and walk from one side to the other. It was a huge mistake. We had very good seating at 75, and then we decided to walk the freaking mile to go see Kendrick. We couldn't even hear the music, and then we're like, screw this, and then we just walked to Subtronics, which was next door, which is good. It was just like a dubsteppy EDM to finish off. And Kendrick's M said that Kendrick's is great, not too exciting. Yeah, that's what I said. I was like, yeah, I mean, who doesn't love Kendrick Lamar? He's great. But I'm like, some bands you have to be like, I don't know if I want to see them live with all the other options. You have to pick, right? But when it comes to how many people, I would say of all the headliners, I would say he was probably the biggest one. He probably drew the biggest crowd, hands down. Top billing. Much bigger than Billie. Like, Billie Eilish, like you could squeeze in and get into there that first night. But that second night, dude, people are already backed up at the second stage next door, turning their backs to that stage to still watch Kendrick. That's how big it was. The one at Tinley Park, at the Credit Union 1 Amphitheater, the Offspring was Sum 41, Simple Plan. No way! Dude, that's like Warped Tour, Keith. That'd be fun. I used to go Warped Tour all the time. That was like my jam in high school. That's funny. High school, college. All right, anyways, back to what we were talking about earlier. Market's looking pretty stable. Like, honestly, I'm not really afraid of what we've been seeing lately. The monthly maps, as we're showing, are starting to show signs of bullishness. It's showing that this event we have is short-lived, and I'm loving it. Give me 1 second. We'll go to the restroom. I'll be right back. Hold on. All right, I'm back. Got in so late last night, didn't even unpack. Get my laptop out, get everything ready to go. Your mom works at Lola? Oh, cool. What'd she do there? Yeah, it does sound like a good lineup, Keith. Long time since you've been here. How's the day going? Currently in the green. No trades going on right now. All I'm doing is testing the futures trading. I'm not technically, there was no call for me. I mean, so no signal for me to see a trade, to take a trade. So I didn't take any trades off of anything other than just slamming the button to buy a couple micros. To still test out some of the features I'm reporting on to my dev team. So today's one of those just do nothing days. Yeah, nothing crazy today. Oh, bartender. Oh, kick ass. But the monthly maps still show a good sign for this week. Like the SPY's going to bottom out, which I like. Let's see what SPY is at right now. Give me a second, you guys. I'm still trying to get everything all set up. Let's unpack it for my trip. I want to see volatility die down. Probably at the end of the day, I'll probably build into a swing trade. I want to see these IVs come down. I might load some premium up and some options for the continual run up. If the market's still looking okay right here, just remember we've got like 1, 2, 3, 4, 5 days of bull swimming in the money. This week is likely to be a bounce week back up. So even like retracing half of it might not be a terrible thing to see this market move. At least to swing halfway back up with an attempt to fill it. If the market's bearish, the next 2 or 3 days, we'll probably get a green candle maybe tomorrow. If it doesn't fill the gap, you can see that we have one kind of bear candle on SPY still sitting there. But the bull side is somewhat deteriorating a little bit. You can see that there's not a lot left. And you can see it as the months go by at this current price, we're kind of in no man's land. the market has nothing to really look at. Slight bullishness and then no bull zones, as you see. So the market, as we keep saying, is going to top in September. The real question is, are we going to double top before it happens in selling? So we are going to be selling September, October. It's inevitable. And we're, like I said on Twitter, it's better to be a bear 1 week late than a bear 6 months early. And it's like people are screaming bearishness all through here, a bunch of idiots. Just market's falling. They have no sense of timing. Trading doesn't care about the greater macro. Trading cares about what's the direction now. Yes, the greater macro is going to win. Yes, monthly maps now show the writing on the wall, right? The bull side, while still being strong-ish, has changed very drastically over the last couple of weeks, especially the last week. We see that bear side is now starting to pivot right at the end of August, okay? In July, we said, ooh, likely bullish until September, September, October, which it did. And the bear side was just deteriorating through then as well. But as we all see now, by September, that bear side turns up. Does everybody see this, right? This is the change. As of last week, we see that. So what just happened as the bears that were like, oh, market's going to crash. We were right. Market's bearish. Look, we look at the positional data. And what originally showed the S&P like essentially rallying kind of through October and then like dead man's land is now showing something different as of last week. We talked about that a little bit ago. It's now showing some upside, but it's likely to hit a top and start selling somewhere here. The inflection point is now moved up towards September. Do we all see that? So what's going to happen, and this was my prediction when I saw this a couple of weeks ago. I said the market is likely to double top by August, September. That's what I said. Experience a month or two of panic selling, and then who knows what happens from there. This is what's going to happen. Does it crash from here? It's possible, but August still looks stable. Keep that in mind. And the reason why I still think it goes up before down, we still have really strong DD number. We still have monthly maps are still looking solid and strong, at least in the short term. So this will change this medium term. So the medium term outlook is that we're not rallying till the end of the year anymore. The medium term outlook is we're going to be fighting as early as September. There is not a lot of bull side left to provide that gamma delta hedging to continue to prop this market up. The market is falling inside a bull zone. So I have to see that. We need to see that bull zone kind of step in and become deeper. We're trading outside of all zones. There is no activity down here yet. Right? So you should, by definition of that, we should start to see DD deteriorate as time goes by, in the high 9s to the 8s to the 7s, as we're no longer in bull zones of certain things. I'm still like coming down from all my festival feel goods. Dizzy. Actually, I'm like super dizzy right now because I took a Xanax before my flight. And then we were delayed like an hour, so we went and got a pizza and drank a beer. Let me tell you, don't ever mix Xanax and alcohol. Even one beer. I was like loopy. I do Xanax because I hate people crowding me. Like, I don't do elevators. I don't do airplanes without drugs. I love heights. I love free falling. I love outer space. I could stare out the window of a plane the whole way I'm flying, but to be crammed in a freaking sardine can with a bunch of people, you people scare me. I get so anxious, dude. Literally get super anxious around just crowds of people. So when I fly, I usually pop a Xanny. It like mellows me out. But don't ever mix benzos and alcohol. And I only drink half the beer, but I was like loopy. I was just like, and Nicole was like, you know, you okay? I was like, oh man, I shouldn't have sipped on that beer while we were waiting. I was just so thirsty. But it's good because you sleep really hard. And I slept really hard and I woke up and I'm still like a little dizzy. It's a good dizzy. It's not like a bad dizzy. It's like, I'm like, ooh, I moved too fast. My brain is still like, go back to sleep, Matt. 4 days of you staying up till 6 in the morning and sleeping until 3 in the afternoon. You got to readjust back to normal life. What do I think makes me like that? Serotonin imbalance. That's typically what causes anxiety in people. I don't know. Everyone has something. That's the thing. Everyone in life has something they deal with. Like, we all have one major problem. Like, all of you can look in the mirror. You all have one thing you're dealing with that you wish you didn't have. Whatever it was. Like, you can't work off those love handles you're trying to work off. Your hair's falling out if you want to stay in. You have a rash that don't go away. Certain area on your face doesn't grow a beard you want to grow on. Everybody's got that one thing they can't deal. My one thing I can't do is anxiety. So my whole life is cool. I mean, I like it. You know, I love it because my whole life makes the smallest things an adventure. I'm always overcoming for the most simple things that you average folks, I envy you. I'm like, how can normal people do this? Why can't I be normal? I envy people who can just like walk in an airport and be crammed with a bunch of people and fucking love it. I'm like, my standing heart rate waiting in line to board the plane is like 130 beats. And then when I get in the plane, it's like 80. That feels good. I'm like, people, move. I'm like, daddy needs to become rich and get a private jet just to avoid people. I don't know. I love people too. It's crowds. I don't know what it is. Crowds just like make me freak out. Like, if I'm on an elevator and I have to go to like the top floor to go to a rooftop club, the elevator opens and there's like 10 people that hop on, I'm like, I'm gonna go by myself. For whatever reason it is, crowds of people. So traffic, I hate traffic too. Like, So my whole life is always overcoming adversity in my way. Everyone has something. I know it might be laughable to some of you, but even driving on the freeway was a challenge for me as a kid growing up. Because people just cramming you in. It's like, push away. Roxy, you're probably playing Hell Yeah. So that's my kryptonite, is I have anxiety around people in closed-in spaces like claustrophobia. That's true. If I buy a private jet, don't make fun of me. That's because I need Daddy needs his space, okay? And I know it sounds kind of funny to say this, but every time I go to a club, I always get bottle service. I always get a table or two because I want my space. I don't want to be crowded in the gen pop. Not that I'm too bougie for it. It's because I literally don't want to be crammed in around people. So that's my thing. So festivals, with all those people piling off, it's kind of cool. But yeah, everyone deals with something, right, in life. But I believe that if there's the powers that be in this universe, or your deity, or whoever you focus your life, attention, love, or worship on, always gives you something that's hard for you to always keep you in check, to grow, to overcome something. It may not seem hard for other people, but if it's hard for you, then your life is always humbling you, which is a great lesson in life, right? Nobody in life is handed everything perfectly. Resilience yellow line. Yeah, can we talk about the difference in rocket scooter yellow line and resilience? Okay, let's talk about them. Now, right now, something's off with the yellow resilience calculation. There's something we need to go investigate on this. Something is, but this only applies the yellow one when you're actually near the yellow. So ignore the yellow one for now because it's a tiebreaker when you're at the yellow. It is correct. Don't get me wrong. It is correct. It just is not moving. The white resilience is the tiebreaker in the redistribution zone. So here, you see where we are? With rational markets, if you take a look at your cheat sheets, outside of the redistribution zone, the top of the box can be support, as you see here. As you see here. Inside of the box, if you are at half gap, it tends to float towards the upper side of the box before the lower side of the box, and that signal was there as well. So support there or floats at the top of the box. You can see generally there's support right where I'm moving my mouse. And those come from the resilience modes right here. Those are the moves I drew at the start of the day. Remember, here to next support. So that leg played out multiple times, just that tiny little leg there. And then support from here to the box was that leg. These are your resilience trades today. Right? So the white line is just tiebreaker around this area right here. That's what you need to know. When ED ratio is high and you have a bull zone above you and below you, does that high DD always push to the upward zone? So let's go to here. Answer your question with the cheat sheet. All it means is bull zone support. That's it. In mean reversion, bull zone tap. In bear side, bull zone touch. That's it. It doesn't mean go to bull zone. This is where you open for the day. There's only one option every single time, Louis. Good question. There's only one option that we do choose. So you open here inside of a illiquidity pocket, which would have said bearish. This is definitely considered bearish at the top half of IP. It's considered bullish at the bottom half of IP. So you have two different cases, right? It's in the middle. Let's assume both of them apply. So let's say we open in bull zone and bear zone. We have this possibility and this possibility today. This one doesn't qualify. So when you open in an IP, it's when you're both bullish and bearish at the same time. It's not like a liquidity pocket where you're not bullish and not bearish, right? Makes sense so far, Louis? So technically speaking, we open on the bearish side of the IP. So that's the one that really qualifies today. If you open an IP and you have a lower bull zone, this one also can work as well. So sometimes you can have two different things if you open right in the middle of the bull and bear case. Now there is no IP case here, right? The algorithm would have clearly classified this one as the one to use. And that from bear zone, which in the IP sense, as we repeat what we said this morning, it's not easy to see unless you go through the videos. An IP is when a bear zone is above a bull zone. The halfway point and higher is considered bear zone. So it's actually bear zone from here to there, even though it's not shaded in. The halfway point inclusive and lower is bull zone. And we open like right slightly in the bear zone. So the move to the bull zone tap only is the move to the bull zone tap only. How cool is that? When you have the option, now that's not necessarily something we teach that you use two different ones, but if you open in the bull zone, now one can argue, okay, it's both bullish and bearish in the middle. So let's take a Schrodinger's approach to this, some quantum superpositioning where they both states exist simultaneously. And one may argue that you can use both of them as well. We don't teach anything other than where you open what you use. But it certainly, bull zones always provide support as long as you open in a bull zone, or if you don't open in a bear zone. So if it's both bullish and bearish, one can argue that both of them apply. And again, as you see, the bull zone is support as well. Aha, how cool is that? They both worked, right? DD doesn't push price anywhere. Keep that in mind. DD does not mean price goes up. DD more likely means price doesn't fall if it's bullish. That's the one thing that somebody who last week was talking to me about this, and it behooved me to I did not understand why they were saying this, because they were like, how is DD so positive yet the market's selling off? And that means you don't understand what we're doing. You need to watch the videos. DD is not, ooh, it's 96. Let me long the market. Today's going to rally. DD means over the course of 6 weeks or longer, we have weekly options that are calculating this DD, which we have an outlook of 6 weeks or more, depending on what we're looking at. That overall, what it means is that you've just got bull zone support over history. Markets can still sell and DD can still stay relatively high. When you leave a bull zone is when DD changes. So that's why if you open in bull zone, it just means that the bull zone is likely to support with a high DD, and that's correct. It doesn't mean I go, oh, DD's positive, let me long out the door. That's not how this works. Do we understand, everybody? Just really quickly. Y'all understand that, right? If you're not bullish and not bearish and you're forced to make a decision, if you are at mean reversion, DD is more likely to go higher rather than lower, because the S&P is more likely to be bullish if the stocks themselves are bullish. If you're opening in a bear zone, you don't tell yourself, aha, it's going to go to the bull zone. You tell yourself that's the highest it's likely to go if it goes up. It doesn't mean it's going there. If you got a hedge pressure right here, it's likely to hit hedge pressure and sell off more likely than it is to break and rally. But your job is if you are the long trader that wants to long and you break through hedge pressure, your brain goes, aha, the max I'm going to look for is that before I sell. DD is not 6 weeks out. DD doesn't look just at 6 weeks out. DD looks at all weekly options that exist. Because it doesn't matter if you bought a call at, I don't know, 4,500 that expires tomorrow, or you bought a call at 4,500 that expires in a month or 3 months, wherever you buy your options, somebody is going to have to long those shares if your call's in the money. So the farther out you buy your option, the probability is much lower that they're going to buy your shares today. So today is here, right? The further out in time your options are, let's draw a graph. The probability of them owning 100% of the shares is much lower than expiration being now. So if you bought expiring option today at 4,500 and it's in the money, let's just say 450 SPY. Somebody today needs to go buy 100 shares literally today. You will force somebody to buy 100 shares from the market to give to you if they don't already have the shares. So in the case, let's isolate this to the case that the person you bought the option from doesn't have any of the shares on their books. You so far so good? Ralph, I'm going to teach you how this works. Do you understand that so far? You shock the market by buying an in-the-money option that expires today. And we're taking the case that that option seller has 0 shares to fulfill. The likelihood of them being exercised on today at 450 is very high. So probably 100% chance that today is the day. What day? What day to full accumulation, right? To full assignment or accumulate for assignment. Likely high. If you bought the same option that expires in 2 or 3 or 4 weeks out, the probability that that trader comes in today and buys 100 shares today is practically negligent. They're probably delta hedging up until the last couple of moments, and then they're going to acquire those shares in the last couple hours of the last day, which is why you see options run up after 2 p.m. on expirations. That's why we don't trade after 2. So, and let me even zoom in on this graph even further. Let me give you an even stronger case for this. As a matter of fact, that probability is more like this. Let me draw another graph. Okay, let's do like expiration, like exactly at 4:15 today, and let's do 2 o'clock today, which is where we don't trade, and then let's do all other days. Like let's just pick a 45 days. In the last 2 hours of the day, it probably looks like that. While my handwriting skills is fucking great. The probability, this graph is the probability that the trader you bought the options from, probability percent that trader is 100 delta or 100 shares bought. In the case they had none, when did they buy them? In the last 2 hours of the day, you can see very rapidly is when pretty much everybody tops off their delta. Whether they were hedged at 50%, 40%, 60%. In the last 2 hours of the day, they are neutralized to assignment. So literally day 2 until forever, people are mostly delta hedging. So they have a partial position. Like if you bought your 450s that expire tomorrow and they're in the money in delta 60, they likely only have 60 shares per contract until the last 2 hours of the day. Tomorrow, they'll go buy the other 40, which is what causes the last 2 hours of the day run up. Do we understand, Ralph? So time is a huge important factor on the probability of assignment. Assignment being, or probability of accumulation for assignment. That accumulation for assignment is that positional pressure that we look for. What we look for in liquidity maps, why we look as far out as there's weekly options, because we have data like this that even though the probability is really small that somebody is longing a lot of shares off of that in the money call, the further out in time, the probability is lower. Because any change in delta, see, imagine that like something 6 weeks out, delta goes from 50 to 60. Okay, they should have bought 10 shares to balance their position. But because it's so far out, what if it lost some due to theta? So they're not necessarily, the further out in time you have more, you're going to have more effect. Not just theta, but other effects. Other things can happen between now and then. Volatility can happen. Options Greeks are all about the probability of striking in the money. So 1,000 things can devalue the option. And so because you're looking so far out in time, you're incorporating all possibilities. IV will change as a function of time. Further out in time will be less affected or more affected by different things. Premiums will change. The shape of the gamma curve will change. You have to look at the entire landscape to answer your question, Ralph. There may be some cases. Now, this is just the case of somebody having 0 shares and needing 100 shares. There could be some cases where somebody that far out needs to buy 100. Since we don't have that visibility of what people are actually doing, everything's probabilities on a base case scenario. One of our major assumptions in the liquidity map model is that outside of that 2-hour window of 0-day expiring options, so anything that is outside of the window of expiring today, the time from 2 p.m. today between now and 2 p.m., all options expiring after today, we assume are going to be delta hedged instead of fully hedged. Now, the idea is that we don't know if a fund who sold options to you or a market maker sold options to you has those shares available. There's no way for you to know that. But the assumption we make is that everyone is delta hedged up until 2 hours before they expire, and then they become fully hedged. And that's why we don't trade during that window, is because at that time, you have no real gauge of people's exposure. The assumption is that most people will delta hedge up until the last day and then accumulate the rest of the position to top off for assignment, as most traders holding options, American style options, we take the assumption that they exercise them on expiration day, which is also an assumption because you can exercise American style options at any point in time as long as they're in the money. We investigated a hedging model that any option that's in the money, well, actually, let me just not get too deep into telling you how a lot of this works. But do you see what's underlying the hood of, and I'm just trying to paraphrase as easy as possible for y'all to understand like the scenarios. There's the hedging model that we assume that calculates hedge pressure, utilizes a hedging model. It's very volatility dependent. It's very time dependent. It's very dependent on the entire landscape of the options world. You must account for all options at all points in time. They all create pressure. The closer you are to expiration, the higher the probability is that person's gonna top off. When I say top off, it means if you're delta hedged, you're in the money slightly, delta 60, delta 70, you're going to have 60 or 70 shares. For a 0.6 delta, you'll have 60 shares of calls in the money. For a 0.4 delta, you're going to be short 40 shares. We assume everybody will just be delta hedged up until the last 2 hours of the day. In the last 2 hours of the day, we assume everybody becomes fully hedged in that 2-hour window. And because you don't know the current exposure or position size of people in that boat, you can't know. And therefore, we don't make a guess. We don't use our tools after 2 p.m. We don't assume their validity. Does that make sense, Ralph? Everyone else? That's why we don't trade after 2 p.m. roll, because that's when everybody's running out rapidly, grabbing whatever they need because they're about to be assigned the position. If somebody's holding an option up until the last day, the probability of assignment goes up. And that person's not just taking profit. So one of the other big parts of the model is that there is a probability of assignment. If you bought a contract that's way in the money today that expires a week from now, let's just say let's put 10 days at the bottom. Probability of assignment at 0 day. We assume 100% of the options are going to assign. And that probability rapidly, the transform looks like this, declines out asymptotically towards 0 within a day. Like the probability on day 1 that somebody assigns in the money is less than 10%. I'm giving you guys some solid gold. I probably should delete this stream, actually. The underlying model of hedge pressure and liquidity maps are based on some very sophisticated linear transforms to solve some very complex differential equations. The probabilities are what we look for, and the assumptions we make create a very sophisticated hedging model. This ain't gonna help you guys. The model underneath the hood is based on so many things. But for your understanding, the probability of assignment, we assume all options will be assigned, speculative or not. No, it's not necessarily ever the case, but it's the most appropriate assumption to make from a risk perspective. From the option seller's perspective, you will assume all options you've sold will be the position will be assigned to you if they're in the money. And so in the model, in the last 2 hours of the day, we assume people go from delta hedged to fully hedged. You haven't found these concepts, Ralph, because I'm not trying, my goal is not to teach people how hedge pressure works. I'm not gonna hand out the holy grail to the public unless I'm on my deathbed. I don't have a successor to the company. Then I might write a book. This is not something you learn. This is not something that's important to you. This is just me rapping. These things won't help you. These are assumptions we make in a hedging model to determine hedge pressure. The probability of how hedged market makers are. It is an assumption I make. The model can't know everybody's positions in real time. It's impossible. In any formulaic approach to creating an analytical solution to a very complex nonlinear problem is to create boundary conditions. You take your nonlinear problem and you solve it with linear algebra. Even if you ever took a linear algebra class, it's how to take very complex differential equation, break it down into partials and solve those partials with linear transforms. It's a mathematical thing. That stuff is not important to you unless you're a fucking mathematician like me. It's the rationale for your approach, but it still doesn't matter. It doesn't help anybody trade better. The assumption, it's not something we'll ever teach. The assumption is just to let you know that, to tell you this is to let you know we put our diligence into creating a very sophisticated model that looks at the probability of assignment, the probability of when people are delta hedge, when do people gamma hedge, how much volatility causes them to IV hedge. These are things we have to create transforms for each portion of the Black-Scholes equation with probabilities to go with them. There's no concept to teach, Ralph. The concept is this. We don't know what people's positions are, so you have to guess. So that's my best guess, is completely worthless to you. You can make your own guess. That's my guess. What found's my guess doesn't create any additional. That's why we don't teach it in the videos. There's no reason to teach that other than other math nerds like myself who are out there trying to create some kind of model for themselves, which none of you will do. None of you will want to do. You can't know somebody's position, so you have to make an assumption. And that rationale doesn't help your understanding of trading. I overcomplicating what you're doing as a trader, this does not help. The more information you have can tend to stimulate more confirmation bias than anything, because we're basing a model on an assumption that who knows when those boundary conditions. There is no science to it. It's all probabilities. Well, I guess there's some probabilistic math to it, right? The goal is to show you that there is rationale to my approach, and that's the whole point. I like sharing that so that people understand that we're not blowing steam up your ass. People understand that I can't even list on a piece of paper all the things I ingested this last weekend. I could still wake up and do fucking math on a Monday morning, which that's great. That's how I was in college, though. I partied my ass off in college. I still graduated cum laude in chemical engineering. I'm a very high functioning partier, that's for sure. But I just want you to know that we rationalize this by understanding that our baseline model is you can't know. You can't know. There's no way. Nobody knows. Even the exchanges don't know. You must assume, and the whole point is to understand when I say assume or guess, is to guess how much pressure, when I use the word pressure, forced buying and selling. We are guessing the probability that forced hand buying and selling will happen. People that don't have the shares have to go get the shares. And can the options hint at that? And we had to create a sophisticated model where it applies in some areas and it doesn't apply in other areas. Hold on one second. And teaching any part of it is revealing proprietary information. My rationale is the $1 billion idea. Hold on. My pencil tool crashed. So for me to have like a more detail, as much as I'd love to have a more detailed discussion with everybody, myself and the partners, we talk about this, the owners of the company. It's part of our model. But why we don't teach in the videos is because when you ask a question, you should understand that any rationale behind how hedge pressure works would ultimately be proprietary, and it wouldn't even be fruitful for anyone to expect it to be revealed in a video. There's a reason why we're better than everything else out there that does the same thing, that looks at options. They're all great services, no offense to them. They all do fantastic work. Spot Gammas and Trade Ticks and all the ones that do the options. Not gonna lie, I love all the people there and they make great information for what they do, but there's a reason why while they're traveling to the moon and we're colonizing Mars, the difference. We're way ahead because we do stuff like that. We're not just drawing out open interest heat maps and stuff to hand out basic option information. Hedge pressure is based on a very sophisticated model that makes assumptions about the degree of hedging for that one single number that you get. It's probably one of the most sophisticated pieces of machinery in Wall Street. It's very sophisticated. It has an army of computers just to calculate it. It's to crunch so much data. So keep that in mind, that having a hedging model is the difference between us and anyone else. Anyone else just providing heat map is assuming all options exists at all points in time with pressure on them. We discard a majority of the options because they fall outside of the boundaries, the boundary conditions. We filter out options that our algorithm believe belong to market makers. Market makers would be the ones that are hedging. A speculative vertical call spread, put spread, buyer or seller has probably zero interest in accumulating the shares. As a matter of fact, if you long the market and sold a vertical put spread against it to hedge your long, to acquire puts in case your long goes down, you're actually liquidating a position that you already have. Nobody would be hedging your position on those options sold because the risk of assignment is zero. You already have the shares. Your options trade exists as a portion of a hedge. For example, you own 100 shares of Apple. You sold one put that's near the money to buy a put that's out of the money. You have a vertical debit spread, vertical credit spread at that point. It exists only as a stop loss that you use the sold side of the option to pay for the buy side. It's a stop loss in a position you already held. You're not selling to anybody. You might likely just be using it to hold your position and not take drawdown. You may not ever assign. Say you did the same thing. So your action is to exit a position. Your action is not to accumulate a position. So while somebody may hedge against your trade, you're not just buying calls to grab the shares on expiration day. Your probability of assignment of buying in the money calls versus selling or buying a vertical debit or vertical put spread to hedge a position you already have. One of those traders might hold through the downside because the put cuts your loss. One person may use that put as a stop loss, selling at a fixed price. The other person is going to use that call to acquire the shares and they had none. The probability of each of you doing something is radically different. Somebody with no shares buying calls that are in the money, if you had visibility of that as the call seller, which you also don't, you have to make an assumption in your risk model as well. Do you hedge that or not? If you can assume that somebody bought calls from you and the calls are in the money, you assume that you need to be long the stock to go. If somebody bought a credit spread from you, it's different. You saw both legs of the trade at the same time. You may assume that they were already short and they bought a vertical call credit spread to hedge their short, and they're just going to be exiting their position to you. And then your next question is, do you want, if they're exiting a short, they're covering, they're buying from you, what if you already have the shares you want to liquidate? Then you're not going to put any pressure on the market. You already have the shares. If you don't have the shares, do you want them? What's the probability that person is just going to be hedging themselves while you're hedging? So they're like hedging and you're hedging. You may not have assignment risk. So sellers of options have to make models the same way we do. That's why we make a model, to assume from their perspective. Hedge pressures and walls are from their perspective of the option seller. So we create models just like they would create models. What's the probability that this type of trade will be assigned? What's the probability this type of trade will be assigned? That's it. And that's why it's like that, Ralph. Each possible scenario has a mathematical transform with it to provide that probability. And time is of very strong importance. So just rapping about how these things work under the hood. It's sophisticated. It very much is. But teaching you that doesn't help you guys do anything in your trades. Yeah. But it does make sense to mathematicians and options traders here. That makes perfect sense, right, you guys? Because if you have to assume how much hedging will take place and if the option seller is going to go buy the shares or not. That's what provides the pressure. And hedge pressure is the highest probability of gamma chain, of share accumulation due to gamma of sold options by market makers. Why is it important that it's market maker options? because market makers are the ones who will be trying to neutralize. People that aren't market makers might not even hedge. Speculators may not hedge, they may hedge. There's no visibility there. But the assumption that all market makers will be delta neutral at all points in time is a valid assumption, right? So if you filter out the options to be market maker only, and then you find the point of max gamma of just market maker options with risk of assignment, then hedge pressure becomes the highest predictable order flow of the options landscape due to market maker delta hedging. Maximum gamma is the maximum change in delta per price at a fixed time. If you look at that differential and then you look at maximum change in delta over price at a fixed time is actually maximum order flow to hedge. With the appropriate hedging model, you get hedge pressure on the dot. And the fact that I get hedge pressure on the dot and it is the highest volume space due to hedging means my fucking model is accurate, is what it means. Which makes me ecstatic to know that, right? The idea that hedge pressure provides high volume flow, it means we've accurately pinpointed where not only dealer options are, which is a holy grail by itself, but their exposure, the probability of maximum involvement in the market due to the exposure as a function of all things that can provide assignment, which is all Greeks are included. And so the coolest part of this whole entire thing is that we predict the highest volume flow due to dealers' hand being forced. Which is why you come here and you can do like hedge pressure break. And you can just pick any stock, just pick something. When you touch hedge pressure and it's the highest volume of the day, you can be like, oh, okay, all right. Homeboy's onto something. This is what I'm saying. I just picked a random stock, Snow, at the top of the list. You see that? You see this? It's because our model is as good as it can get, right? That is the highest volume spike. The fact that I've isolated that, it means I've mapped out where market makers are positioned very accurately. It's only a matter of time for some hedge fund buys or technology. You guys got to realize this. Love it while you can. I promise I'd negotiate if someone ever bought us out. The idea that we could still keep the retail platform open, but that'll be something I'll try my ass off to go for. Predictable high volume is what we aimed for, predicting volume, and that's a way to do it. And it means we've effectively, like I said, mapped out where dealers are positioned, and dealers with the assumption that they're the ones hedging. Speculator, like, you may not hedge. You buy an option, you're doing zero to the market. You go buy some SPY options, you're not buying and selling SPY. You have no effect on SPY. Hedge pressure is where the dealers will be forced to buy and sell or shift. When gamma is the highest, the change in delta is the highest, the change in order flow is the highest. Their change in order flow being the highest means the volume's the highest. And that's exactly right. These are the people that would be hedging. Now, not everybody's hedging because you know everybody's exposure, but using bulk statistics of the entire bulk set of data, you can assume that if most people are delta hedge and you're outside the 2-hour window, then at that point in time, you interact with this. All options, to answer your question, whether they expire today or tomorrow or the next day or the next day, this is the area of all prices that exist of that highest shift in positional change due to the forced hand side of the market. Anytime you touch hedge pressure, it's a volume spike. Here's the biggest one. Why is there two volume spikes? Well, maybe somebody decided to pull the trigger here and didn't there. Somebody decided to pull the trigger there and didn't there. They all have different risks and exposures. But you know that every time you touch hedge pressure, get close to it, there are going to be some people acting based on the risk of their exposure. The fact that there's different volume spikes wherever is because these are different firms acting at different points in time. But overall, you see the accumulation or the change at hedge pressure every time. The idea that when you tap hedge pressure and there is a volume spike no matter what, like literally no matter what, When you touch hedge pressure, there's a volume spike. It means we not only have a model that works, we have a universal model that works. So we pinpointed not only where the dealers are mapped out, but how they hedge. The probability of where they hedge, we've mapped that out where the highest is. And we create a universal model which proves that everybody hedges the same way across the universe, across the world, for all things. That the stock market is simpler than you thought. People use one methodology in a firm, an asset management firm. They don't have a different methodology for each stock. They do the same thing for all things. One sophisticated risk model that they use for all things. Because we can find a hedge pressure in every stock. Hedge pressure might be the ideal place to capture gamma. You nailed it. The thing is that it's because if you assume speculators aren't going to be hedging, right? Your calls that you bought, you don't want to assign, you don't want the position, you just want the calls for money, right? For a gain. Pretend that the option seller knew that. They may not know that, but they might speculate that about you. Let me start over. You sold an option for just profit. You're the option seller. You're probably going to be delta hedging against it. If you're a market maker, you make money on just providing liquidity. You're actually incentivized monetarily to hedge. Because the more neutral you are, the more money you have in your pocket. If you sold a call that goes in the money and you're not hedged, there goes your buying power, right? You're down money. You're losing money. But if you just invest a little bit of money to offset your position at zero risk, because you're delta hedged, an example, then you're not taking a loss. So you have more money to, again, provide more liquidity to the market. More money means more liquidity. More liquidity means you can engage in more trades. More trades means you get more maker-taker fees being a market maker. So market makers are financially incentivized to hedge. And the more neutral they are, the more money they have uninvested that they can trade with. Does this make sense? So they are financially incentivized to be perfectly neutral. Not only from their own risk perspective, to not take long or short side risk if they don't want it, but just buying power to begin with. If you have every one of your trades neutralized and you just get paid to trade, then the highest cash flow you make from trading equals directly proportional to the number of trades you make. On a probability, the highest probability, on a spectrum, the highest amount of trades you can make is maximized by the least loss that you take in your account. You can trade only the amount of money that you have. So if you minimize your loss to zero, you've maximized your buying power at minimum risk. So therefore, the incentive for a market maker to be perfectly neutral at all points in time maximizes their cash flow for providing liquidity. So the assumption that all market makers delta hedge is very valid. Does that make sense, Green? So hedge pressure being the ideal place to capture gamma rides on that assumption. It doesn't matter what stock you pick. When you interact with hedge pressure, there will be some volume, which is great. And that's why I tell people, it's like, you know, now you may not see, it's right here. As you see, average volume down in here, and as you interact with hedge pressure here, volume starts to ramp back up. It's right here. Not this one, not necessarily the highest volume of the day, but it still provides volume flow. The noise of the market, you get a spike in volume and a decay in volume. You get people acting right here above the average. My mouse is about where the average volume is, right? And you can certainly see as you get close, there are little spikes. I'm just picking random stocks in the list. Palantir. Hedge pressure tap right here, volume spike. Now again, it has the degree of volume and the amount of volume has to do with the exposure of the company. I mean, the exposure of the dealer or the seller. But you can see the first touch of hedge pressure, there's a volume spike right here. right out the door. Boom. That second minute candle, look how high that was, right when you touch it. Subsequent taps, there's another volume spike, a smaller one, less of one. You can see that people usually make one decision. It's not rapid, large spikes. Once people decide, okay, it's time to get in the other side of the trade, whatever, they act right here. And then a different firm acted there, a different firm acted there. But it's the highest probability of capturing gamma. And the proof that you're capturing gamma is the high volume flow that you experience each time you interact with it. That's your gamma, right? Does that make sense? He said it took years to formulate hedge pressure. But I'll tell you something. I used to write sophisticated differential models of chemical reactor that had hundreds of thermocouples in it, hundreds of side reactions, catalysts that conditions change. Imagine this, the stock market assumption that market makers always delta hedge is valid. They don't ever change that. Imagine doing the same thing for a dynamic environment. A catalyst in a reactor is like your iPhone battery. You charge it once, it stays active for 4 hours. You charge it again a month later, it stays active for 3.5 hours. Charge it again, 6 months later, it stays active for an hour and you gotta recharge it. That battery decays over time. So your model is time dependent as well. Your model is only good for a small portion of time until some of the mechanisms inside the framework change. So imagine doing like this for a chemical reactor, so I did, where you yielded 90% of your product right when the catalyst is out the door. Actually, catalyst overheats at the start. And it's funny, actually it's dynamic. So the cool thing about catalysts work hot out the door. You actually have really high conversion and then lower conversion that would isolate on a sweet spot. Over like a 10-year life of your catalyst, your model would be like overshoot, undershoot, stabilize. And you economically like plan for a sweet spot. It is a very complex. So anyways, like I said, I got good at mapping out complex mathematical systems in my career as a young whippersnapper, in the chemicals world. We're gaming the market maker. The idea is that if the market makers behave consistently, which the assumption is they do, then there's a trade idea, something that's consistent. And that's what you want in a trading, in a trade idea for yourself. A consistent behavior that you can bank on. So what is consistent in the stock market? Well, price action is not consistent. That's why technical analysis doesn't work as a gauge of the stock market. That price history is never a proof of consistency. But if every market maker is financially incentivized to delta hedge, then if you assume they do, and then try to find the place where they do it the most, then you have a pretty good model of something that's consistently there. And the proof that the model works is the volume spike at hedge pressure. That proves the theory correct. Well, two theories correct. Number one is all market makers are financially incentivized to delta hedge, therefore they do. Check. And that you can predict predictable volume there, is that's the highest probability that you will see gamma change in the market, delta hedging, or max delta hedging, which means max order flow. It's often the highest volume spike of the day, not guaranteed to be the highest volume spike of the day, because again, the real hedging is based on the exposure of the firm and do they have the shares or not. If they have the shares, maybe they won't do anything. But across the board as a bulk statistic, we take the bulk flow statistic that most people will be in the position they need to acquire. So like in the fluid dynamics world, because I used to teach fluid mechanics at University of Houston when I was an undergrad. There's two different types of approach when analyzing bulk statistics. This is kind of fun. You have Eulerian and Lagrangian method of bulk analysis, and this is what these two words mean. And we utilize this very heavily in our model. Water flowing in a pipe has a flow distribution like that. Like, this is just water in a pipe, okay? And you can analyze water flowing in a pipe a certain way. You can map out one particle and follow what it is and use the math of that one particle. or you can use the Eulerian, which is you're using a bulk statistic. And so you can either look at a distribution, like things move faster towards the middle and slower towards the edge. Therefore, you have a distribution of velocity probabilities. And then you can map out the overall velocity of the water because you know you're looking at this. Or you can grab one particle and create an equation for that one particle, but that equation is dependent on where in that pipe it is. So you take two different approaches to the market. We take like the Eulerian approach is that you have, you know, Euler, Euler, you know him, right? The mathematician. Is they're using a concentration, like in the fluid sense, like particle is one event or one thing that you're mapping out, one dealer, one market maker. And you can't make the assumption because every market maker, every particle here is going to have different risks, different exposure, different pressures. There's pressures on a pipe, different pressures. As a bulk, though, you can, if you actually turn your head on the side, one may assume that, you know, that looks like a bell curve, right? There's a distribution where the probability near the center is that the majority of things are moving at a relatively similar pace. And so you're mapping out this shape through the pipe in a bulk sense. And that's kind of what we're doing here. The probability is that how many people are hedging here? Well, there's some people that aren't on either side, but the majority of people are likely. And so we take that approach in our math, which I love to detail. When you study, anybody that study engineering, you can take that, and the difference between the two styles is per particle or per particle distribution. You can either, what's one market maker doing right here? But you can't take that approach. And if you say like, what's one market maker doing here? And then what's another one doing here? And then what's another one doing here? And let's add them all up. That's your actual most correct approach. But the idea is that you can't use like a Lagrangian style analysis because you don't know what anyone physically is actually doing. If you had the data point to measure each particle in a water stream, which you can't, you would get the most accurate view of what's going on inside that pipe. You know what every particle is doing at every point in time. And we literally know what nobody's doing. Nobody can. So we have to take that statistical approach. Exploiting incentives. Ingenious, frankly, but execution of the idea is the game changer. Roxy. Well, thank you. Knowing that you don't know cuts your work in half. The assumption that you can't predict the stock market eliminates the idea that we take down that fruitless effort to chase it down that you can. If I had the visibility of every market maker's position and risk and exposure, I can write a Lagrangian style model that would predict the stock market and never be wrong, because I would know when everybody hedged at exactly the moment they hedge. If I knew all their hedging models for each independent firm, could add it all up, I can create a master equation for stock market. Fortunately, that doesn't exist and will never exist. But probabilistically, the simplest approach is to assume humans are incentivized by money, find out those incentives, and find out where everyone behaves the same way for their maximized incentive of the group. It's as Nash equilibrium at its finest. Everyone behaves in a sense to which they maximize their own benefit plus maximizing the benefit of the herd. Providing liquidity to the market keeps your neighbor afloat, because if your neighbor crashes, then they crash you too. So everybody is kind of tied together to keep the market floating as a herd and financially incentivize themselves to maximize and compete for getting order flow for liquidity. The fact that people sell order flow in this business is proof of the power of liquidity, making money for people. So that even incentivizes them to neutralize faster. And this is a space race to see who can be as get order flow as quick as they can and neutralize as quick as they can. Therefore, hedge pressure becomes even stronger. So that's cool. I'm glad you guys hang around for the science talk. But you have to assume a bulk statistic, because you can't know what each individual firm is doing. It's impossible. So the math, so it basically takes your approach to creating equations down two different roads. So now you can create equations based on probabilities. You create probability possibilities of what's probably this is going to happen at this point in time, or the probability that this is going to happen at this price, probability this is going to happen at this volatility, and you create like differential equations, partial differentials for each particular case in Black-Scholes, and create a probability model inside of each one of them. And now you can take that bulk approach, because the way that I describe the water in a pipe is that you have this kind of distribution where the probability of a particle moving through a pipe at a constant pressure applied to all points in that pipe, things in the middle are going to move faster than things on the edge. And it's going to look like this. If you turn this on your side, it's a bell curve. So you have a probability distribution. You map out probabilities, you have a much better way to map out the market. If everyone's incentivized to move the same way, then this bell curve doesn't change much, no matter which angle you look at it or what point in time or whatever. So like our models, like a array of curves like that. So that was the incentive for me to do this, to make this. Now, believe it or not, it may sound complicated. It's much easier than mapping out a chemical reactor. I'll tell you that for sure. Because your catalyst changes over time. So A plus B doesn't always make C. A plus B makes hundreds of things, and the percent spread of what it makes changes over time because your system changes over time. So you have to create a model for how your model changes. Lucky for us, the hedge pressure model doesn't change. The hedging model is static. If they were to change their behavior, which is impossible for them to do, delta hedging is the most accurate way to neutralize risk. There's new versions of options pricing models, like newer than Black-Scholes. Everyone still uses Black-Scholes. If they were using different, more accurate ways to volume price options, which some of them do, then obviously we can use the same approach with those newer models and still come up with a pretty static approach to hedge pressure. Like, I don't have to go reformulate hedge pressure every week because the dealers don't change what they do. The models I'd write for Dow Chemical from the reactors I ran, it's a model that would change over time. So the equations, the whole set of equations would change. The hundreds of transforms on the thousands of relationships, all those shapes of those bell curves would change on a daily basis. There was a time dependency to them. But you had to forecast how your catalyst changes as it cycles. I always tell people, what does that even mean? It's like your battery in your iPhone. It only holds so much charge, and each time you do it, it holds less and less and less. You can create a time dependency of how much juice you can get out of your iPhone. Then you have a whole new layer to your model changing. How much does it cost you over time in electricity to have an iPhone? You'd have to create a model and then a change of your model. Right? And the stock market's much simpler than that. It doesn't change over time. People do the same thing today that they did yesterday, which made it very easy mathematically. Hang in for the science talk. Are you kidding? This is amazing. Finally have deeper understanding of the market and have true faith in the platform. Thank you for sharing. Oh, well, appreciate you, man. I'm glad I didn't scare you away by telling everybody I was drunk off my ass and popping Xanax on the plane and stumbling around the airport. People realize I could still wake up and do math. I'm definitely a functioning partier. But that's because I work so hard. I have to get out and do something fun every once in a while. You don't see me like hip hop dancing at Lollapalooza. You'd probably be like, who's this clown? Who's this goofball? But it just makes sense when you think about it. I mean, it's not a hard approach. I mean, sorry, it's not a hard concept to wrap your head around. If you sell options and you're a market maker and you neutralize your risk, you have more money in your pocket to sell more options. The more you neutralize your risk, the more buying power you have. You'll know if you're an option trader, you do the same thing. You go out there and buy a call, it eats into your buying power. If you go out there and sell a call when you buy your call at the same time, you get credit for the risk that you don't have. So you have more margin to play with. You all know that if you ever go out and trade options. You get credit for the risk that you don't take. So the more neutral you are, you can keep buying and keep buying, keep selling, keep selling. As long as you remain neutral, you can engage in more trades per hour. As a market maker, your money is made by making pennies on the dollar for every trade you engage in. So why would not everybody maximize in their little space race to all do the same thing, which is to compete for order flow? Because all I can do is hedge out and they get free money. So to get the free money, you're going to just hedge the best way you can. Everyone still uses Black-Scholes. We assume that. And then we just throw some probabilities on the probability of each scenario, put some boundary conditions in there. And it's a classic engineering problem to figure out something that's consistent and behaves consistently. And like I always say, the proof is the high volume of hedge pressure is proof that we did our homework, which is good. I just ran hedge pressure breaks on here. Anytime you break through hedge pressure, you're going to see volume. Volume spike, volume spike, volume spike. That's everyone's exposure and actions. So here, opening volume, and then you're interacting with hedge pressure, spike, 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 spike. I'm glad you guys are here, and I'm glad y'all are learning from us, and I'm glad that you're a fan of the platform, and we really love you guys. Now look, here's an example. Nicola, while you did interact with it, it is a volume spike. Check this out. The break here is the highest volume of the morning up to that point, other than the open. Volume is down as you're getting closer. More and more people are hedging. But you can see that consistently when you touch hedge pressure is always a volume spike. That's what we say. Now there's an even higher volume spike down here. And what's the cause of that? There is no understanding of why this happens. This is completely random. Who's buying right here? You have no idea. What caused that volume spike? Well, not everything is visible. This could just be a human doing something. You don't know. That could have been somebody's stop loss. This is clearly a penny stock. Somebody could have just dumped all their shares right there. There's no explanation. It's clearly a higher volume spike than the hedge pressure, but it doesn't matter. The consistency is still there when you interact with hedge pressure. It always spikes volume and decays volume. That same volume distribution always takes place no matter what. It's even a penny stock and it's doing it. But again, penny stocks are illiquid. So it's not just liquidity driving the market. You got people pumping and dumping this stuff too. And you can see that right there at about the $2.30 range, it had a massive dump as somebody maybe could have got liquidated, a margin call, the things you can't explain. So not everything in the market is explainable, but we assume that not everything's explainable and we don't even try to explain it. There would be no reason for me to guess what happened here. But it's not hedge pressure being mechanically a predictable high volume that's often the highest volume of the day, minus one-offs. But the fact that no matter what you look at, touching hedge pressure and breaking hedge pressure is a huge volume spike on any single thing, which is like, that's what I love. Everyone I picked is the same exact story. Here you go. Look at this. SoFi. Gives you faith in the platform. Well, thank you. I love you. I'm glad that you guys stick around for the nerd talk because honestly, I did put years of work into building my models. And I do it for fun. I love doing it. When I was an engineer, and that's the one thing I did miss. That was the most fun job I ever had. I was trying to guess what a chemical reactor was going to do over time so I can optimize how much money we squeeze out of that lemon. When do I buy my new catalyst? 6 months later, 3 months earlier than planned. If we run it slightly hotter, can we get some more juice out of our yields? How does the yield change if we do that? Like all these little mechanics. I constantly go out there and tell the operators, hey, these 4 data, can you add 2 extra degrees to these thermocouple limits and subtract 1 here? Constantly maneuvering a giant machine to operate efficiently using dynamic math models. I was like, oh, I love my job. And so obviously when I get to the stock market and all fucking stock market clowns are drawing squiggly little lines on their charts based on price action, I'm like, there's no way that this does any, there's no way that people make money doing this. This is complete stupidity. I was like, there's no way. Squiggly lines, the basis of a dynamic system like the stock market. And the truth is that they weren't. You guys know that. So I was like, all right, Crack my knuckles, engineering hat on. Let's go. Trades both winners today, always because hedge pressure. Baby. You guys are awesome. Love you all. All right, I'm going to take a break. Let me get out of here. I'm going to go water my plants, pick up my cats, unpack, do some laundry, and chill. I would love you guys. Market's stabilizing. Let's go ahead and analyze this at the end of the day. Monthly maps are looking very strong this week. It's a very strong candidate. The volatility is going away. The volatility is going away. Volatility is going away. The volatility is going away. I love it. We want to see this go away, and we're good for the medium haul. Okay. I want to see right here that volatility go away, at least for the next week. We're probably going to fill that gap, which I'm excited to see. Right? That bull side is diving in. Those calls are going to be in the money. The probability is higher. They're going to be longed. Let's go. I like what I see, everybody. Okay. All right, love you guys. All right, we'll see y'all later. Futures, we're close, very close. We got a few more bugs we got to work out, and we're good. But I like what I see. SPY's looking okay. Resilience is looking okay. Nasdaq's looking pretty good on the hourly chart. I like what I see. Like I said, we're still limited on the S&P today. There's DD band up here. So I had to be very careful. Right? Obviously, today might not be the day that we rally and do anything. But just keep an open mind, right? I do like what I see on these monthly maps. I can't lie. Oops. That at least for the next week, it does look good, even on NASDAQ, which is the one I was worried about. Do we see this? Well, it gets a little wonky going into next couple months. Let's just be real. This and this is great for like a 1 week, 2 week swing. Does everyone understand what we teach, right? The monthly map looks great for what we see. The space in here is volatility, and the space is very small, which means VIX is going to be in decay, which means the probability that this credit event, but these bears are yelling and screaming about, ain't starting this week. My opinion. There is no volatility for this week. VIX is likely to decay. Right? The bull side is stronger, bear side is weaker, bull side is stronger, bear side is weaker. So we're probably going to do that this week, and I'd like to see a press towards double top. I think starting today and tomorrow, market's going to be down again. We get a catalyst tomorrow, next day, move the market another way. But so far, so good. The monthly map is positioned like we wanted it to be. At least for a week, it looks great. Now, after that, it gets a little thin. On the bull side, but at least for now, I'm going to assume that we might run up to top. I do like what I see. Okay, love you guys. We'll see you tomorrow. Don't forget, thanks for joining Nerd Talk today. That was my TED Talk. Going over mathematical things and whatnots. We had a good week. I'm glad to be back in the saddle. Glad to get ready to launch futures trading for you guys. This is a huge, huge, huge milestone for the company. Obviously, creating live trading inside the platform is always a dream. This is one step many to open up multiple brokers, multiple things down the road, stocks, options, Forex, crypto, probably have everything. For now, we're going to launch this futures thing. We're excited about it. Within a month or so, we'll be doing, you have everything. It's your futures accounts here. You can do your
trader funding programs here. You can have all kind of fun things coming out. About to automate DD bands. All these things are coming out next couple weeks as well. So you have to be in Pro Plus. Upgrade, and get the deal. Give me a message. I'll send you the coupon for that if you want the deal to upgrade. We love you guys, and we'll see y'all very soon. We'll do a little Zoom call tomorrow. No Zoom call today. We had a long stream. We'll do a Zoom call tomorrow. I'm going to catch up with the devs, and we'll see y'all later. Have a good day.